A portfolio with just SCHD is like driving a reliable sedan. It gets you there, but you might be missing some serious acceleration. Many investors discover this after watching opportunities pass them by. Ever wonder how a small tweak could mean an extra 3 to 5% growth annually? In this video, I'm sharing the 4 best ETFs to pair with SCHD for maximum wealth building potential. These are strategically selected to give you exposure to high-growth tech giants like Nvidia and Amazon, while maintaining that solid dividend foundation you love about SCHD. If you're serious about building wealth faster, this might be the most important video you watch this year. Have you ever wondered if your SCHD investments could be working harder for you? Today we're examining the before picture of your investment journey. SCHD has earned its reputation as a dividend investor's favorite for good reason. With a robust 3.5% dividend yield and 13 consecutive years of dividend increases, it delivers reliable income that many investors count on. These strong fundamentals have made it a cornerstone holding for income-focused portfolios, and its low expense ratio ensures more dividends stay in your pocket. While these numbers are impressive, they mask significant sector gaps that could be holding back your wealth-building potential. The most notable constraint is SCHD's sector concentration. When examining its portfolio allocation, you notice heavy weighting in financials, consumer staples, and industrials, creating substantial gaps in your exposure to key growth sectors driving recent market returns. Particularly concerning is SCHD's limited exposure to technology and communication services, sectors that have delivered the market's strongest performance. During the 2020-2021 tech boom, for instance, Nvidia shares rose over 300%, while SCHD had minimal exposure to this growth. SCHD's methodology focuses on companies with consistent dividend histories, automatically excluding high-growth companies that reinvest profits into operations rather than distributing them. This focus on dividend-paying value stocks means missing out on tech giants like Apple, Nvidia, Microsoft, Amazon, and Meta, responsible for a significant portion of market gains. These companies either don't pay dividends or don't meet SCHD's strict requirements, leaving a substantial gap in your portfolio's growth potential. The opportunity cost of an SCHD-only approach becomes clear when examining returns. Over the past decade, while SCHD delivered respectable results, portfolios with broader market exposure significantly outperformed it. A $10,000 investment in SCHD 5 years ago would have grown nicely, but that same amount in a growth-oriented fund would likely have performed substantially better. This performance gap compounds over time. Even a 2 to 3% annual difference can translate into tens of thousands of dollars in foregone wealth over a decade. Money left on the table due to sector concentration. Portfolio overlap is another important consideration. Think of it like buying multiple identical tools when building something, redundant and inefficient. When selecting ETFs to pair with SCHD, choose those providing exposure to companies and sectors not already in your SCHD position, maximizing diversification from each additional investment. Strategic ETF pairings can effectively fill these gaps while maintaining your valued dividend income. By combining SCHD with complementary ETFs, you maintain your income stream while adding exposure to growth sectors. This creates a more balanced portfolio that performs well across different market environments, like adding upper floors to a house with a strong foundation, capturing the full potential of the market. Ready to add those upper floors to your investment house? While your foundation is solid, SCHD, Schwab US Large Cap Growth ETF, might be the perfect addition to transform your portfolio from merely stable to genuinely dynamic. This ETF tracks the Dow Jones US Large Cap Growth Total Stock Market Index, focusing exclusively on companies with substantial growth potential. SCHG has zero holdings overlap with SCHD. making them perfect complements. When combined, they create a complete investment structure, like adding an entirely new wing to your property without disrupting existing foundations. The contrast becomes clearer when examining SCHD's holdings. While SCHD prioritizes dividend reliability, SCHG embraces technology powerhouses. Its top 5 positions, Apple, Nvidia, Microsoft, Amazon, and Meta, represent approximately 55% of the fund. These tech giants have been market performance drivers for years, yet remain completely absent from SCHD's portfolio. SCHG's composition reveals strategic sector allocations. Technology dominates with nearly 50%, followed by communication services and consumer discretionary sectors. This creates the perfect counterbalance to SCHD's value-oriented approach that emphasizes financials and consumer staples. SCHG maintains a low 0.04% expense ratio, just $4 annually per $10,000 invested. Its dividend yield sits at approximately 0.4%. But SCHG's purpose is capital appreciation, growing your principal investment over time. And grow it has. SCHG has delivered exceptional performance with average annual returns exceeding 20% over 5 years and nearly 16% over the last decade. When comparing 10-year charts, SCHD performs like a racing sports car that leaves the steady SCHD sedan in the dust during bull markets. A 50-50 allocation between these funds would have turned a $10,000 investment into approximately $38,500 over the past decade, compared to roughly $30,000 with SCHD alone. This pairing creates a barbell strategy, balancing stable, income-producing assets with higher growth potential. It's like having a steady paycheck while maintaining ownership in a rapidly expanding business. SCHD provides consistent cash flow and reduces volatility, while SCHG amplifies your wealth-building trajectory. This combination addresses both short- and long-term financial goals. SCHD satisfies immediate income needs and stability, while SCHG maximizes your portfolio's future value. Together, they create a more complete investment strategy than either fund could offer individually. For investors concerned about market timing, the SCHD-SCHG combination reduces pressure to predict which investment style will outperform next. Rather than timing market rotations between growth and value, you maintain exposure to both simultaneously. This approach recognizes that diversification across investment styles can be just as important as diversification across sectors. Now that we've explored balancing growth and value styles, let's talk about building a broader foundation. Did you know that adding VOO to your SCHD holdings instantly gives you exposure to approximately 80% of the total U.S. market capitalization with minimal overlap? This powerful combination might be the simplest path to a truly diversified portfolio. The Vanguard S&P 500 ETF, or VOO, tracks the 500 largest publicly traded companies in America. Despite both funds focusing on large, established companies, they share only about 7% of the same holdings. This minimal overlap means you're genuinely expanding your investment reach rather than doubling down on companies you already own through SCHD. VOO fills the crucial market exposure gaps that SCHD leaves open. While SCHD concentrates on dividend-paying value companies, VOO captures the entire market spectrum, including tech giants like Apple, Microsoft, Nvidia, Amazon, Meta, and Google. These technology leaders have been major drivers of market returns in recent years, with tech companies accounting for a significant portion of S&P 500 gains, exposure you'll miss with SCHD alone. VOO's remarkably low cost structure features an expense ratio of just 0.03%. You're paying only $3 annually in fees for every $10,000 invested. That's about one-third the cost of the average ETF in the industry. And while VOO's dividend yield of around 1.2% might seem modest compared to SCHD, when you blend these funds, you still maintain an attractive income stream. With a 50-50 split between SCHD and VOO, your portfolio would deliver a blended dividend yield exceeding 2%, while your combined expense ratio would be just 0.035%. If you had invested $10,000 in each fund a decade ago, your combined $20,000 investment would have grown to over $31,000 today, collecting steady dividend income while benefiting from substantial capital appreciation. The SCHD VOO combination performs across different market environments. When value stocks are in favor, SCHD typically outperforms. When growth leads, VOO's technology and growth exposure drives returns. Rather than trying to predict which investment style will dominate next, you maintain exposure to both simultaneously. During market downturns, SCHD's value orientation and higher dividend yield provide stability and income. During bull markets, VOO's growth components typically drive stronger capital appreciation. This dynamic helps smooth out your investment journey while potentially enhancing returns. With just 2 ETFs, you've constructed a portfolio that spans investment styles, captures most of the U.S. market, and maintains income generation. This combination works particularly well in tax-advantaged accounts like IRAs and 401ks, where you can reinvest dividends without immediate tax consequences, though it's equally viable in taxable accounts for long-term wealth building. Tax-efficient investing is smart, but what about those who need substantial income right now? Picture receiving monthly dividends that could pay your bills. That's the promise of the JP Morgan Equity Premium Income ETF, JEPI. It has become one of the fastest growing ETFs in history, paying monthly dividends at a remarkable 7.3% yield. This yield doubles what traditional dividend funds offer, creating an immediate income stream that transforms portfolios. JEPI's power comes from its covered call strategy. The fund sells call options on its stock holdings, collecting premium payments from investors who want the right to buy those stocks at predetermined prices. These premiums generate significant additional income that JEPI distributes as monthly dividends. This strategy involves a key trade-off. By selling call options, JEPI caps some upside potential during strong bull markets. If stocks surge dramatically, the fund might underperform pure growth investments because those call options limit profit from rapid price increases. The reward is that powerful 7.3% yield paid monthly, creating predictable income. Consider how this might work in real life. A retiree with $200,000 invested entirely in JEPI could receive about $1,200 monthly, enough to cover utilities, groceries, and other essential expenses without touching the principal investment. JEPI and SCHD complement each other perfectly, sharing only about 8% of the same holdings, while giving you exposure to entirely different companies across the market. JEPI's portfolio includes approximately 129 holdings, with significant positions in companies like Visa, MasterCard, Progressive, AbbVie, and Meta. The fund maintains strong exposure across financials, technology, healthcare, and industrial sectors, creating a well-diversified foundation. On costs, JEPI charges a 0.35% expense ratio, $35 annually per $10,000 invested. This remains reasonable given the specialized strategy, with the net yield still impressive at nearly 7%. To illustrate, a $100,000 portfolio of just SCHD would generate around $3,500 in annual dividend income. By allocating $50,000 to SCHD and $50,000 to JEPI, annual income jumps to approximately $5,400, a 54% increase while maintaining exposure to quality dividend growth stocks. JEPI's monthly payment schedule aligns better with typical household bills and expenses than quarterly dividends. The covered call strategy also tends to offer greater stability during market downturns, as option premiums provide a cushion against price drops. Since inception in 2020, JEPI has delivered annual returns exceeding 12.5%, demonstrating that income doesn't require sacrificing total returns. During periods of market volatility, income from selling call options helps offset price declines, making your overall portfolio more resilient while providing the monthly cash flow many investors need. What if the secret to building sustainable wealth isn't high current yield, but companies that increase their dividend payments like clockwork every year? While maximizing immediate income is important, there's something powerful about investing in businesses that consistently grow their payouts over decades. The iShares Core Dividend Growth ETF, DGRO, takes this approach by focusing on the most reliable dividend growers in the market, potentially transforming modest yields today into substantial income streams years from now, much like planting a sapling that grows into a mighty oak, providing abundant shade and fruit over generations. SCHD and DGRO take fundamentally different approaches to dividend investing. Where SCHD emphasizes quality companies with higher current yields, DGRO specifically targets companies with consistent histories of raising their dividends annually, regardless of their starting yield. While they share about 16% of holdings, this moderate overlap actually reinforces positions in the absolute best dividend companies while providing access to hundreds of additional quality businesses. DGRO's broad approach becomes evident with its impressive 411 holdings, which dwarfs SCHD's more concentrated portfolio. This extensive diversification spreads your risk across more companies and sectors, potentially smoothing out returns during volatile periods. Its top positions include healthcare giants Johnson & Johnson and AbbVie, financial leader JP Morgan Chase, energy powerhouse Exxon, and tech titan Apple, providing substantial exposure across multiple sectors. Cost-conscious investors will appreciate DGRO's minimal 0.08% expense ratio, meaning you'll pay just $8 annually for every $10,000 invested. The fund's current dividend yield sits at approximately 2.1% paid quarterly. Many companies in this fund have increased their dividends annually for 10, 20, or even 50-plus consecutive years. Imagine Sarah, a 40-year-old professional who adds DGRO to her portfolio. Today, she receives modest quarterly payments, but as the years pass, these dividends grow steadily and predictably. By retirement, what started as a small income stream has transformed into a substantial financial river flowing into her accounts. Combining SCHD with DGRO creates a dividend durability shield, a resilient income stream capable of weathering different economic conditions. When inflation surges, companies that consistently raise their dividends help maintain purchasing power. During recessions, companies with decades-long dividend growth records typically prioritize maintaining those streaks, offering stability. DGRO has delivered approximately 14% annual returns over the past 5 years and over 11.5% for the past decade, slightly outperforming SCHD over 10 years. However, the real benefit is enhanced diversification, reduced sector-specific risk, and exposure to a complementary dividend philosophy. Consider the power of a dividend growth. A company paying a 2% yield today, but increasing its dividend by 8% annually, will be yielding nearly 4.5% on your original investment after just a decade, and that's before counting any capital appreciation. DGRO specifically targets these dividend growth stories, many of which might not qualify for SCHD due to its different selection criteria. So what's the ideal allocation for your portfolio? That depends entirely on your personal goals. If generating consistent income is your priority, leaning heavily into SCHD and JEPI might make sense for you. Growth-focused investors might prefer a larger allocation to SCHG and VOO. Those seeking balance can distribute investments across all 4 ETFs, adjusting percentages based on risk tolerance and time horizon. Take charge of your financial future with a simple first step. Test a 50-50 split between SCHD and one complementary ETF that addresses your biggest portfolio gap. Then adjust as you become comfortable with each component's role. Redesign your portfolio today. Transform from SCHD dependent to strategically diversified.